All right, let's dive in. Today, we're talking about international finance. And I know that sounds a little intimidating, right? But honestly, think of it more like a giant global money maze. It's this incredibly complex puzzle that connects every single one of us in ways we don't even realize. So let's grab a map and start figuring this thing out. So, what are we really talking about here? Well, at its core, international finance is just everything that happens when money, credit, and even risk decide to cross a border. And the crazy thing is how those flows impact, well, everything. The price of your morning coffee, the big decisions made by massive companies, even what governments do. It is literally the engine room of the global economy. Okay, to make sense of this whole maze, we can kind of break it down into four key pillars. First, you've got the instruments, the actual tools being used, like currencies, bonds, all that stuff. Then you've got the players, the firms, investors, and governments making all the moves. Of course, they all have to follow the rules of the game. And finally, you have the outcomes, the real-world results of all this action, like currency swings, economic growth, or even financial crises. So let's start by mapping out the absolute key components of the system. We're going to look at the big questions that drive the whole field, the major players on the board, and the one huge rule that everyone has to follow. First up, probably the most visible piece of the puzzle, exchange rates. I mean, why does the value of the dollar versus the euro or the yen change like every single second? Is it just random market noise and breaking news, or are there much deeper economic forces at work over the long haul? Figuring this out is absolutely central to international finance. Next, you've definitely seen the headlines, right? Country X has a huge trade deficit. Country Y has a surplus. But why? Why do these imbalances even happen? And maybe more importantly, is it actually something we should be worried about? This is where international finance gives us the tools to see past the scary headlines and really understand what's going on underneath. And finally, let's put ourselves in the shoes of the decision makers. Think about the CEOs, the central bankers. How in the world do they manage all this financial risk when a single tweet from halfway across the globe can completely wreck their bottom line? This is exactly where all that theory smashes right into the real messy world. So, who are these main players making all the calls? Well, you can basically break them down into three groups. You've got your firms, and they're mostly worried about protecting themselves from currency swings and, just funding their day-to-day operations. Then you have investors who are constantly trying to build the best possible global portfolio. And finally, you have governments and their central banks. They're the ones looking at the really big picture, overall policy and keeping the economy stable. Okay, now for the one rule to rule them all. It's this fascinating concept called the impossible trinity. Basically, any country in the world wants three things: a stable exchange rate, money to flow freely in and out, and the power to set its own interest rates. That's independent monetary policy. Sounds great, right? Here's the catch. You can only ever have two of the three. That's it. You can't have it all. This single trade-off defines the fundamental choice every country has to make. It's the ultimate rule of the game. All right, that's enough theory for now. Let's see how all of this plays out in the real world. We're going to jump into a case study, a hypothetical one set in the near future. We're looking at the Mexican peso in August of 2025. And just look at this. It's a perfect example of a global chain reaction. On July 24th, the European Central Bank decides to hold its rates steady. Okay? Then, 2 weeks later, Mexico's central bank does the opposite. It cuts its rates. And boom, just a few days after that, the exchange rate between the US dollar and the Mexican peso reacts. See? This isn't a coincidence. It's the global financial system working in real time. And here's the specific move Mexico made. They lowered their main policy interest rate down to 7.75%. Now, in the world of finance, a move like that is a huge signal. See, lower interest rates can make a country's currency less attractive to foreign investors because they're always chasing higher returns on their money. And here's the result. This is the market's reaction. The exchange rate settles right around 18.68 pesos for every US dollar. That number is not random. Not at all. It is the collective wisdom, or panic, of millions of decisions made by investors and businesses, all reacting to what that interest rate cut means for Mexico's economy. Okay, now it's your turn. I'm putting you right in the driver's seat. No more watching from the sidelines. You are now the chief financial officer of a company called Mexigear, based in Mexico. And you've got a really big decision to make right now. So here's the situation. Your company owes a supplier in the US $5 million. That bill's due in 90 days, 3 months. Right now, the exchange rate is sitting at about 18.68. But here's the problem. You have no idea what that rate is going to be in 90 days. It could go way up, it could go way down. Your company's profits are on the line. So you basically have two main options. On one side, you can hedge. That's a fancy word for using a financial tool like what's called a forward contract to lock in an exchange rate today for that payment you have to make in 3 months. It gives you certainty. You know exactly what you'll pay. On the other side, you can just hold and wait. You wait the 90 days and just pay whatever the market rate is then. Now, this could save you a ton of money if the rate moves in your favor, but it could also cost you a fortune if it goes the other way. It's that classic trade-off, certainty versus risk. And this decision you're facing right now as the CFO, this isn't just some textbook exercise. This exact dilemma, where you're balancing those huge government policy trade-offs like the impossible trinity we just talked about, with your own company's very real risk, this is the absolute heart of applied international finance. This is where it all gets real. So what's it going to be, CFO? Are you going to protect your profits and lock in a rate for that certainty? Or are you going to bet on the market, hoping for a better outcome? There's no single right answer here, but making that choice, weighing those risks and rewards, that, right there, is international finance in action. So, what would you do?